Hello everyone, welcome to Investing 101. Lesson 1. Investing is for everyone.
He's looking at you, kid.
A lot of people out there don't invest at all because they don't understand it. They think it's just for the rich and the corrupt, those greedy, powerful people out there.
Greed, for lack of a better word, is good.
They think it's too risky, that it's essentially just gambling, and for many other reasons. But investing really is for everyone. It's not that risky as long as you do it the right way and stay focused on the long term, and it's definitely not just for the rich. In fact, if you're not rich, it's even more important for you to invest. Because if you're rich, you already have a lot of money. If you're not rich and you don't have a job with a lot of income, then it's going to be hard for you to build wealth. And investing is the best way for you to build wealth. There are 4 main reasons why investing is important for everyone. Number 1, investing is extremely important for you to provide for your own retirement, so you don't have to rely on the meager payouts of Social Security, a system that is facing increasing uncertainty. Number 2, investing can provide security and freedom even in the present day. Stock dividends and bonds can provide an income stream that you can reinvest during the good times or that you can use as a safety net during the bad times. Number 3, investing is a lot better than saving because if you just save, that cash is going to lose value over time due to inflation. For example, from the year 2000 to the year 2017, the United States experienced inflation of about 32%. This means that if in the year 2000 you could buy 100 loaves of bread with $100,
It's a lot of dough.
that in 2017 that same $100 could only buy you 68 loaves of bread. So if you want your dough to rise instead of fall, you need to be investing, not just saving. Number 4, investing allows you to take advantage of the power of compounding and grow your money exponentially over time, making time your financial ally instead of your enemy. We'll talk more about this in Lesson 2. Before we end this lesson, I want to finish with a couple caveats. First, if you have a lot of high interest debt, such as credit card debt, it's important that you pay that off first before you start to invest. A great book that can help you get rid of that debt as quickly as possible is Total Money Makeover by Dave Ramsey. You want to get rid of that debt as quickly as you can so that you can start investing and building wealth. But if all you have left is low interest debt, like a mortgage, it's a good idea to go ahead and start investing, especially in retirement accounts like your 401k. The reason is that you want to be diversified. If you're putting all your money into paying off your mortgage and you don't invest elsewhere, then your only asset is going to be your house. Now that's a good asset to have, but it's not diversified. It's not diversified across assets, it's all in real estate, and even worse, it's all in one property of real estate. In a later lesson, we'll talk even more about the importance of diversification and not having all your eggs in that one basket. Second, time horizon is a very important consideration.
Now, bring me that horizon.
If you're going to need the money in the next 1 to 3 years for something like a down payment for a house, you don't want that money in a risky investment like stocks. Because even though stocks are going to be your best long-term investment, they're going to be very volatile in the short term, and you don't want to have to sell those stocks when they're really low in order to fund something else. So if you're going to need the money in the near future, you want to put it in something safer like a bond or even a high-interest savings account. Finally, a lot of people struggle with setting aside money for investing in the first place. If this is you, that's not something that we're going to be covering in this course, but there are a couple books that will really help you with putting aside a little bit extra money each month. One is You Need a Budget by Jesse Meacham, and another is The Financial Diet by Chelsea Fagan. However, a big point that I really want to make here is that it doesn't take a lot of money to be successful with investing. Over the long term, if you saved $50 a month for 40 years and got just the average return from the stock market, 10% a year, you would have $270,000 at the end of that 40 years. Not bad considering you only put in $24,000 of your own money over that time frame. We'll talk more in a later lesson about how you can achieve results like this. But the important takeaway here is that it doesn't take a lot right now to make a big difference down the road. In our next lesson, we're going to be talking about when you should start investing. A little spoiler, the answer is right now.